There's a reason Warren Buffett called this book, by far the best book on investing ever written. The Intelligent Investor by Benjamin Graham isn't just a book, it's a mindset. This isn't about chasing the hottest stocks or trying to outsmart the market. It's about building real, lasting wealth, quietly, patiently, and smartly. And today, I'll give you the core ideas from this timeless masterpiece. But not just a summary. You're about to learn how to think like an intelligent investor, not just act like one. Let's start with the big one. 1. Separate speculation from investing. Most people don't know the difference. If you buy a stock because it's trending on Reddit or because someone said it's going to the moon, that's speculation. It might work once. But over time, it fails. Investing, real investing, is buying a piece of a business. It's looking at the fundamentals, the value, the leadership, the future potential. Benjamin Graham teaches, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. If that's not the reason you're buying, you're gambling. Simple as that. And most people don't realize, they're not investing. They're just hoping. Let that sink in. If you're just hoping something will go up without knowing why, you're not an investor. You're a speculator. And the market punishes speculators in the long run. Bells, stick around. Because later, I'll share a principle that saved Warren Buffett millions, and could save you decades of mistakes. Mr. Market is not your friend. Benjamin Graham introduces a character called Mr. Market, and he's emotional, unstable, and irrational. Every day, Mr. Market offers to buy your shares or sell you his, at wildly different prices. One day he's euphoric, offering you sky-high prices. The next, he's depressed and selling for peanuts. Most people react emotionally. When prices go up, they feel rich. When prices drop, they panic. But the intelligent investor? He ignores Mr. Market's mood swings. He takes advantage of them. This simple idea is genius. You don't have to react to every movement in the market. You wait. You watch. And when Mr. Market offers you something truly valuable at a discount, you act. Until then, you do nothing. Imagine how much calmer you'd be if you stopped checking your portfolio every hour. Imagine investing based on facts, not fear. That's what Graham teaches. And Buffett? He built an empire by following that principle. Bell now, before we go deeper, make sure you're subscribed. This is the kind of content that doesn't just entertain, it transforms how you think about money. 3. Margin of safety, your greatest shield. This might be the most important concept in the book. A margin of safety means you never pay full price. You always leave room for error. Because mistakes happen. Forecasts go wrong. Companies stumble. If a stock is worth $100, the intelligent investor won't pay $100. He waits until it's $70 or $60. Why? Because even if something goes wrong, he's protected. Think of it like this. Would you cross a bridge if it's designed to hold exactly your weight? Or would you rather it support 10 times your weight? That's a margin of safety. It's the buffer that keeps you from disaster. Most investors lose money not because the idea was bad, but because they paid too much. No cushion. No safety. One stumble, and they fall. The intelligent investor always asks, what if I'm wrong? And then protects himself before he invests. This one principle could save you from losing tens of thousands over your lifetime. Or more. 4. Know who you are, defensive or enterprising. Graham divides investors into two types. Defensive. Enterprising. The defensive investor wants simplicity, peace, and safety. They don't want to analyze stocks all day. They focus on long-term, diversified investments. Think, index funds, blue-chip stocks, strong bonds. The enterprising investor is willing to put in the work. They research deeply. They look for undervalued companies, distressed stocks, special situations. And they manage risk carefully. But here's the trap. Most people think they're enterprising, but act emotionally. They read a few headlines, chase the hype, and panic during crashes. That's not enterprising. That's gambling. Knowing your type is powerful. It tells you how to invest, where to focus, and what to ignore. You don't have to beat the market to be wealthy. You just have to avoid big mistakes, and stay the course. Bell, if this is making sense, pause, and like the video. It helps more people discover content that actually helps them grow financially. Let's go deeper into one of Graham's most powerful lessons. 5. Focus on value, not price. Imagine walking into a store. You see a watch priced at $300. You Google it later, and realize it's worth $1,000. That's value. Now imagine another watch. It's $1,000, but only worth $300. That's overpaying. Same with stocks. Some are cheap for a reason. Others are expensive, but still undervalued. The intelligent investor looks beyond the number. He looks at earnings, future growth, leadership, and competitive advantage. Buffett once said, 6. Don't time the market, trust the process. Many investors try to jump in at the bottom and sell at the top. Sounds smart. But in reality, almost no one can do it consistently. Even the best investors don't know what the market will do next week. So instead of guessing, the intelligent investor focuses on time in the market, not timing the market. Graham encourages dollar-cost averaging. That means you invest a fixed amount regularly, monthly, quarterly, regardless of what the market is doing. Sometimes you buy high. Sometimes low. Over time, it averages out. This removes emotion. It builds discipline. And it works, especially over decades. Think about this. If you wait for the perfect moment to invest, you'll probably wait forever. But if you start consistently, you build momentum. The intelligent investor doesn't try to be clever. He builds a habit. A process. And he sticks with it, even when others panic. Because in the long run, the market rewards patience, not prediction. Bell, we're almost done, but the next point is so powerful, it could change how you look at your portfolio forever. Stay with me. 7. Beware of market noise, and financial media. Turn on any financial news channel and you'll see it. Charts flying. Tickers blinking. Pundits yelling. It feels urgent. Important. But most of it? It's noise. Graham warns against letting short-term headlines shape your long-term strategy. The intelligent investor doesn't chase news. He filters it. He knows. The more noise you absorb, the more likely you are to panic, overreact, and make costly decisions. Remember Mr. Market? He lives on your phone now, through notifications, tweets, and breaking news alerts. Every dip becomes a crisis. Every rally becomes a frenzy. But the intelligent investor? He tunes it out. He reads company reports. Annual statements. Books. He seeks clarity, not hype. Most wealth is built in silence, not in reaction. So next time there's breaking news, pause. Ask. Does this affect the long-term value of my investments? Or is this just noise? Smart investors don't need to react fast. They need to react wisely. Bell, we're heading to the final point, one that ties it all together and gives you the mental edge most investors never develop. 8. Master your emotions, or be mastered by them. This is where most investors fail. It's not lack of knowledge. It's lack of control. When the market crashes, fear takes over. When it soars, greed kicks in. And both lead to terrible decisions. Graham teaches that the biggest threat to your portfolio is you. The intelligent investor builds emotional discipline. They don't panic during downturns. They don't chase during bubbles. They stay rational when others are losing their minds. This doesn't mean you become a robot. It means you build awareness. You ask yourself, why am I buying this? Am I reacting emotionally or logically? Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. It's not easy. But it's what separates the few who build wealth from the many who lose it. If you only remember one thing from this video, let it be this. Real investing is emotional mastery. The rest is technique. So take these principles. Write them down. Live by them. And remember, building wealth isn't fast. It's steady.